She tracked every dollar for 90 days, not loosely, precisely. Every coffee, every grocery run, every subscription, every tank of gas logged into a spreadsheet she built herself because she was serious this time. She was going to figure out where the money was going and fix it. At the end of 90 days, she had her answer. The money wasn't going anywhere surprising. There was no hidden leak, no embarrassing category where she was wildly overspending relative to her values. She was living, by any reasonable measure, modestly. She just didn't earn enough to cover the cost of a modest life and save anything meaningful at the same time. The spreadsheet didn't have a solution for that. No spreadsheet does. And that is the conversation that almost nobody in personal finance wants to have, because it doesn't sell courses, doesn't generate affiliate revenue, and doesn't make for a satisfying video about 5 habits that will transform your relationship with money. The reason saving feels impossible in 2026 for a significant portion of the American population is not behavioral, it is structural. And until you understand the specific structures working against you, every budgeting tip in existence will feel like being handed a bucket and told to bail out the ocean. Here is what is actually happening. Start with the cost side of the equation, because this is where the story really lives. The 3 largest expenses in most American household budgets are housing, transportation, and healthcare. These are not discretionary categories. You cannot cut them to zero. You cannot comparison shop your way to a dramatically different number. They are the fixed floor beneath which your monthly spending cannot fall regardless of discipline. In 2026, all 3 of them are at or near historic highs relative to median income. Housing costs, rent, and mortgage payments combined across the population now consume an average of 35 to 40% of take-home pay. In most major American metros, the traditional financial guideline was 25 to 30%. That guideline assumed a housing market that no longer exists. Transportation, because American infrastructure was built around car ownership, making it effectively mandatory for the majority of the population, now averages over $10,000 per year per vehicle when you include the payment, insurance, fuel, registration, and maintenance. For 2-car households, that is $20,000 annually before a single other expense is paid. Healthcare premiums for employer-sponsored plans have increased an average of 5 to 7% per year for the past decade, consistently outpacing both inflation and wage growth. The premium is the visible cost, the deductible, the copays, the out-of-pocket maximums that reset every January. Those are the costs that arrive unexpectedly and destroy whatever buffer existed. Add those 3 categories together for a median American household, and you have consumed, conservatively, 65 to 70% of take-home income before food, utilities, childcare, debt payments, or anything that might be described as living rather than merely existing. Now here is the income side, and this is where the structural argument becomes impossible to ignore. Median real wages in the United States, wages adjusted for inflation, meaning what your paycheck actually buys, grew by less than 1% annually over the past decade. In several years, they shrank. The cost of the fixed expenses described above grew at 2, 3, 4, 5 times that rate during the same period. This is not a coincidence, and it is not a mystery. It is the documented, measurable result of an economy where productivity gains, the increased output that workers generate as technology improves, flow disproportionately to capital rather than labor. When a company automates a process and becomes 30% more efficient, that efficiency generates profit. The profit goes to shareholders. The workers whose labor environment just changed receive, on average, a 3% raise that doesn't cover their increased cost of living. You are producing more value. You are capturing less of it. And the gap between what you produce and what you receive is precisely the gap that makes saving feel impossible, because it is not a feeling. It is math, specific, documented, directional math that has been moving against the average worker for decades. Here is where the personal finance industry enters the conversation, and where it consistently fails the people it claims to serve. The dominant narrative around saving is behavioral. You spend too much. You prioritize the wrong things. You lack discipline. You need a budget, a system, an app, a set of rules, a mindset shift. This narrative is extraordinarily convenient for an industry built on selling solutions to what it has defined as a personal failure. It is also, for a significant portion of the population, simply incorrect. A 2023 Federal Reserve study found that among Americans who reported difficulty saving, the majority cited insufficient income, not overspending, as the primary constraint. When researchers controlled for income levels relative to local cost of living, the behavioral explanations largely disappeared. People with enough margin saved. People without enough margin didn't. The insight is almost insultingly simple. You cannot save what you do not have. And the number of Americans who genuinely do not have margin, not because of lattes or streaming subscriptions, but because fixed costs have consumed it, is larger than the personal finance content ecosystem has any financial incentive to acknowledge. There is a particular cruelty embedded in this moment that deserves to be named directly. The people for whom saving is is genuinely structurally difficult are also the people most exposed to financial shocks. No emergency fund means a medical bill, a car repair, or a few weeks of reduced income becomes a debt event. Debt events are expensive. Interest, fees, penalties, the compounding cost of carrying a balance. Expensive debt events consume future income that could have become savings. The inability to save creates the conditions that make saving harder. This is not a poverty trap in the traditional sense. It is a squeeze trap affecting people who are employed, who are functional participants in the economy, who are by most visible measures fine, but who are operating without margin in a system that punishes the absence of margin severely and consistently. Here is what is true and worth holding on to. For some people, in some budget situations, behavioral changes produce real results. Automating savings before spending, auditing subscriptions, renegotiating fixed costs where possible. These things are real and they matter at the margin, but the margin they create is smaller than the industry suggests. And for a growing portion of the American workforce in 2026, the margin they create is not large enough to produce the kind of financial security that the same industry promises is available to anyone willing to make the right choices. The honest conversation, the one that doesn't fit neatly into a 5-step framework, is that saving in 2026 is structurally harder than it has been at any point in recent American history for the median worker. Not because people changed, because the math changed. And the math changed because of decisions made by institutions, policymakers, and market structures that individual budgeting habits were never designed to overcome. Here is the question that the spreadsheet cannot answer. If the inability to save is structural rather than behavioral, if it is a feature of the economic environment rather than a failure of the individual inside it, then what is the actual solution? And more uncomfortably, who is responsible for building it? If this reframes something you've been blaming yourself for, share it with someone who needs to hear that the problem might be bigger than their habits. And if you want to understand the full picture of what's shaping financial life in 2026, the next video is already waiting for you.